The Fed just flipped the script. In fact, they just came out and said that the chance of a recession is now sitting at 50%. In fact, our buddy, Jay Powell, came out just a couple of months ago and said we're not in a recession. But this is coming after a time where we saw 2 negative quarters of GDP growth. And as many of you know, a recession by definition is a fall in GDP in 2 successive quarters, which you can see by this graph here, we actually had in Q1 and Q2 of this year. In fact, the only reason the Fed hasn't completely capitulated on the idea that we're in a recession is because job growth has remained somewhat strong through the Fed continually raising the Fed funds rate over the course of the last year. But with that said, I want to take some time and talk about the Fed's new plan, if you will. Talk about what you're likely to see at the next Fed funds meeting, how the Fed is likely to respond, and whether or not that could actually end up to the Fed pivoting. At the end of the day, most of you don't care what the Fed does. You just want to know how it's going to impact you with regards to real estate. And that's exactly what we're going to dive into in today's video after you smash that like button. This past week, the Fed's bullard came out and said that we've got a ways to go with regards to rate hikes. At the same time, Fed Chairperson Williams is saying that the Fed inflation fight could last until 2024. Williams said that he expected that rates would have to rise in 2023 to somewhat higher levels than he had penciled in during earlier projections. Stronger demand for labor, stronger demand in the economy than I previously thought, and then somewhat higher underlying inflation suggest a modestly higher path for policy relative to September. Not a massive change, but somewhat higher. So basically what the Fed is saying in short is that they're going to continue to fight inflation and raise rates in the short term, which is exactly what the projections are showing from interest rate traders with regards to the December 14th Fed funds meeting. As you can see here, there's a 69% chance that the Fed is going to hike 50 basis points and nearly a 31% chance that they could hike it 75 basis points. But what's really interesting is when you look at the projections over the last month, if you will, if you go back to October, they were sitting at nearly 50%, with almost half of the people expecting a 50-point basis hike and the other half expecting a 75 basis hike. But as you can see here, there was a small percentage of people predicting that the Fed may only hike it 25 basis points at that time. And then just a week ago, it went to 75% of people looking at a 50 basis point hike, where the other 25% was looking at a 3/4 hike. And as we mentioned a moment ago, we're currently sitting at about 70% looking for that 50 basis point hike. And Jerome Powell has more or less confirmed that, basically saying that smaller rate hikes could start as early as December, in addition to saying that rates will raise more and likely stay there for some period of time. So at the end of the day, we know the Fed is going to continue to fight inflation by raising the Fed funds rate, which at this point is no surprise. And as we saw last month, when the Fed did what was expected, on top of the CPI numbers actually coming in lower than expectation, we saw a huge rally in mortgage rates. In fact, mortgage rates are down once again week over week, currently sitting at 2-month lows. Now, we already know what the Fed is going to do, more or less based on the projections that I showed you earlier, and we know if they follow through with that, the market has more or less already baked that into the cake, so you shouldn't see any huge swings in one direction or the other. The real news coming up is what's going to happen with regards to CPI, which is the Consumer Price Index. It's the Fed's measure of inflation. In fact, there's 2 measures of inflation that the Fed looks at, the headline inflation as well as the core inflation, but the core inflation is really where they focus their attention. Core inflation actually strips out energy and food, and how they get their measurement of inflation is they take the inflation numbers from each month and they calculate them over a year, and that comes up with the inflation numbers. So when November readings of this year come out, December 13th, that means November of 2021 is actually going to drop off. And as you can see from this chart here, we're going to lose a 0.5 reading from November of last year. So if inflation stayed the same as last month, then we're likely going to see inflation drop once again. Now, I'm not here trying to sell you some bag of goods that inflation going down, going to all of a sudden make things better. But what I'm going to tell you is that inflation numbers are going to continue to move down. And this is going to show the Fed that what they're doing with regards to raising the Fed funds rate is actually working. Now, with all of that said, I don't expect the Fed to pivot immediately, but I do think they're already showing some signs of pivoting, slowing down, if you will, by now acknowledging the fact that we could be going into a recession, on top of now considering smaller rate hikes like we're likely to see in December. Now, there are some people out there that believe inflation is actually set to plummet. The graph that I'm about to throw on the screen here shows the correlation over the last 20 years between small businesses and inflation. This chart holds up like it has in the past, then we're likely to see inflation move down a lot quicker than anyone thought. Assuming the correlation holds up as it has for the last 20 years, we should expect inflation to normalize quickly. Now, they do go on in there to say that this time is not like any other time in the past, but if history repeats itself with regards to that chart, you could see inflation come down sooner than possible, which means that you could see the Fed pivot sooner than possible. The Fed's ideal target rate for inflation is sitting around 2%. And while we're a long way off from that, the closer we get to that number, the more the Fed is going to back off. And at the same time, we know as inflation comes down, interest rates tend to follow. Now, how is all of that actually going to affect housing? Well, the latest data shows that housing prices have slid for the last 3 months. At the same time, we've seen pending home sales decline for 5 straight months, declining nearly 4.6% in October. Now, if you've been watching my videos for any period of time, you really shouldn't be surprised with regards to less home sales out there with some home price declines. Remember, we appreciated over 40% in just a 2-year period, which is way out of the norm. The housing market for the United States has appreciated on average about 4.6% over the last 65 years. So when you see homes appreciate 40% in such a short period of time, you have to expect that you're going to see some pullbacks in prices, which is exactly what we're seeing at the moment. And those markets that appreciated the most, the fastest, those markets like Boise, Austin, Vegas, San Jose, and Phoenix, those markets are also seeing the steepest price growth slowdowns. And this is coming at a time when the Federal Housing Finance Agency once again just raised the base loan limits, which means that people can now qualify for even more home without it actually being a jumbo loan, which means they can likely take advantage of lower interest rates. So my expectation with regards to interest rates in the housing market is that it's going to be a slow roll for the next couple of months. I would say the next 4 to 5 months, you're going to see home sales kind of move along sideways, not really a lot of growth happening unless you see interest rates move down quickly, which I don't expect to happen. I think interest rates are probably going to trade in this range between 6 and 7% over the next couple of months, which means housing is likely to remain sluggish. Now, if you saw inflation shoot up for any reason, that means interest rates are likely going to shoot up along with those inflation readings, which could put further strain on housing, but I don't expect that to happen. In fact, I think there's a really good chance that interest rates ease back down between that 5 and 6% range within the next 6 months, which could get some buyers off the fence and help stimulate the housing market. Now, we're not going to see anything like we saw over the last couple of years, but it could allow housing to pick up a little bit and in turn help things kind of chug along, if you will. Now, if you're a buyer out there at the moment, just make sure you have a longer term time horizon, and not because I'm expecting some housing crash, no, not at all, but more because of what we mentioned earlier with that crazy home price appreciation in just a short period of time. You actually need home prices to move sideways, even down for a period of time to allow it to catch up. So with all of that said, I'd love to know what your thoughts are. Where is inflation headed? Where do you see interest rates going? And ultimately, what do you see with regards to housing prices? Do me a favor, leave it in the comments below. But if you want to see the proof on how we nailed inflation coming down last time and how that impacted interest rates in a positive way, do me a favor and check out this video here.